All right, so this is just an intro video on infinite banking, how I've used it, why I felt okay doing it, what I like about it, stuff like that. So if you're wanting to learn, at least get an intro to it, I definitely recommend this book. In short, every new Rockefeller that's born, they're not touching old money. The way that they grow their wealth and are able to access a lot of capital, like essentially all the generations moving forward, they get a whole life policy. It's a very unique whole life policy. It gives the highest cash value that you can get on a whole life policy as early as you can. And then there's different degrees, different types of whole life policies that work with this, but it's the whole life policy that when an insurance agent is selling to you, it's the one they get the least commission on. So that is a big reason, if you are familiar with whole life, that you may not have heard of this type. It's because the people that sell it, they're not incentivized. So yeah, in short, this book is great if you're wanting a lot more detail as well. Here is another. I don't know if this one is as necessary. And then the third resource, this is who I actually have my policy through, is this team, Money Multiplier. They have a lot of content, explanations, stuff like that. And so, yeah, I wanted to just look at the policy I purchased. I started with a basic policy. Probably later this year, early next year, I'll open up a second policy on myself, and then gradually for the rest of my family. And so the first policy I opened, I used to purchase this house. And so it was a Subto deal. I opened an infinite banking account, and then in short, you're able to borrow against the policy, and I could access that capital pretty quick. So I'm rounding, estimating. I think total I put in about 9,000, and then I was able to pull out about 80%, more specifically borrow against. And so yeah, it was pretty cool. So I get a death benefit on that policy of like 200,000. So if I pass away unexpectedly or eventually when I pass away, my family would get 200,000 for the one policy, and it grows each year as well. The more capital you add to it. Yeah, put in roughly 9K, borrowed roughly 7, and used it to pay a large chunk to buy this property. And so, yeah, the next part I want to show is kind of my own policy, unique things on it. And so the base is 3,800 annual, roughly. And then there's different things you can do to influence all these numbers. So I paid the base, and then I did what they call a dump in, which helps accelerate a lot of the numbers and overall process of what I'm explaining. So as soon as the policy is active, there's the death benefit. And again, this is without adding anything else. And then here's the cash value of what you could pull out. And then if you want to get real technical, borrow against the policy, use it as collateral. And I added almost double this, a little over double this. So these numbers are different, but they're any of the benefits that you see in the example. When you add more to the policy per year, a lot of benefits are enhanced, like in terms of percent, stuff like that. So a couple of things I want to point out though. What's really cool is you're getting a guaranteed percent growth, which is like 3%. And then they've performed on these, there's only 4 or 5 major companies that offer this type of policy, and they've paid every year for over 100 years. So when they say guaranteed, it's essentially as close as you can possibly get to guaranteed. And then they also pay a dividend on, not to get too technical, but any overflow that they may have as a company. So it's like if they pull in a certain amount, but they only pay out a certain amount, and they pay dividends on that difference. And so total with the guaranteed and the bonus dividend, you're getting about 5.5% and of your money of the cash value. And what's really cool though, and this is where the true magic happens, is it's compounding. So 5.5% may not sound like a lot, but when you know it's going to happen, it's compounding. Which, unlike the S&P 500, they say the annual is like 7 or 9%. But what they don't really explain is if it goes down 9% one year, and then the next year it goes up 9%, you're actually not at your original starting point. You're slightly below the original point of beginning. So you'd have to really look at examples and stuff to fully understand that, but just know that compounding at a guaranteed rate is very, very powerful. And so a couple of other things I want to point out on this. So if I just did this, that's the death benefit. And you can have multiple policies. I think you can go up to like almost 3 million, the death benefit, before they really start even asking for a lot of documentation, tax returns, stuff like that. So it's pretty easy to get, pretty easy to do, especially if you're a certain age, you don't smoke, stuff like that. The next couple big things I want to show though is, so right here, and again, I've added more, so my numbers are better, especially when you look at it from a percent. But just for this example, simple, by year 10, you've added 38,400. This is where it starts getting interesting. Here's your total death benefit, and here's the total cash value, like what you can borrow against the policy. So there are different policy types where you see it takes 10 years for this to finally catch up. You could essentially pull or borrow all the money that you put in. There are different policies where it can happen a lot more aggressive or a lot sooner. There are different pros and cons when you're making changes like that. So pay attention to that 38K. You can borrow this much against it. There's your death benefit. This is where it starts getting really interesting. By year 20, you've put 54,900 in, but you can borrow this much against it, 71,000. So this is where the true magic starts kicking in. And you can see the benefits of when you start an infant with one of these. By the time they're actually like an adult, they could use this money to start a business, pay for college, whatever. And then it really, each year, this phenomenon, this principle starts kicking in more aggressively. So check out by year 30, I have the math written out already, but the total contribution is 71,520. However, you can borrow 125 again. And what's really cool though is technically you don't have to pay this back. Pretend you've borrowed all of that and your death, when you pass away, essentially it would just be subtracted from your death benefit. So you can access this capital within your lifetime, and you don't have to pay it back necessarily. Like I personally am just doing this and buying properties, and so you don't have to pay it back. And this principle continues to like exponentially grow. Like you're putting in, like by this time of the year in the policy, whenever you put 1,600 in, the policy, the cash value is growing. You can see here it goes from 125 to 131. So it's growing a little over 6,000. So you put 1,600 in, then you have access to 6,000 though, 6,000 more, almost 6,700 here. And so that's what's so cool about it. You can protect your family with the death benefit, and you can access capital in unique ways that allows you to continue to grow, like for me personally, my portfolio. And so last thing I wanted to show is, up until recent, I thought for our son, buying technology stocks was best for him. Like he's 18 months. When he was 2 months old, I started buying shares of this for him. And I mean, by the time he's 20, if I buy one share a year for him, he'll be very well off. Well, what's interesting is up until recent, I thought that was the best choice. It actually is the infinite banking. So Just wanted to share this with anyone that's curious about infinite banking. And these principles I showed, there are a lot of little other tips and tricks that you can do to accelerate this process. Like I call this the efficiency point whenever you put that much in, but you can access substantially more, essentially triple. You can make that happen a lot faster. There's a lot of strategies and stuff, but I just wanted to give this basic intro video on infinite banking. I am a proponent of it. And the last thing is the cash value, it is growing at about a 5.5 annual. When you borrow against the policy, it's almost the same. It's like 5%. But, and you have to study this, the resources, even if the compounding is only 5 and pretend that when you borrow it was like 6, so it's higher. The math is really weird, but because of the compounding effect, you're still a net positive. You're still growing, as weird as that may sound. But yeah, I encourage anyone that's curious about this to at least check out this book. And then if you have questions, hit me up on Instagram.